Welcome back to Morning Trade Live. Time to go inside out on the energy sector. Stewart Glickman's with us, Deputy Research Director, Energy Equity Analyst at CFRA Research. Stewart, great to see you. Your thoughts on the action that we've been seeing in energy. There was a moment where we were close to $70. I want to go over some of the buy ratings that you have on some of the names. What's the big picture on energy, which I guess can be inflationary if you're buying gasoline and it goes up, but where do we stand here?
Yeah, hi, Nicole. Thanks for having me. So big picture, energy kind of had like a brief 15 minutes when Iran and Israel were, really in the heat of the battle between them, and oil went up considerably. It's pulled back a lot since then. So we've kind of been marooned in this mid 60s area for WTI crude oil. I think the fundamentals for crude right now they're not awesome. They're not terrible. We seem kind of stuck in this, I would call it a mediocre range. And I mean, there are concerns on the demand side. There are concerns on the supply side. So they're kind of battling back and forth right now. I think the big picture here is that energy investors probably, unless, the geopolitics really ramps up considerably, probably we're looking at somewhat mediocre pricing, at least this year, maybe some improvement next year.
And so these names that you have buy ratings on, I see you have Kinder Morgan, you have Schlumberger, and more. Tell me about some of the buy ratings you have. Why now?
Sure. So I'll differentiate between Kinder Morgan and everyone else here. The reason being that Kinder Morgan is a midstream play. Midstream depends far more on volume growth than it does on the price of, for example, natural gas or crude oil. As long as prices are high enough that the volumes are still flowing, that's what matters to midstream. So Kinder Morgan has a great franchise in natural gas movement, particularly in the Permian Basin. Of course, everyone knows the Permian Basin as being, the workhorse of U.S. crude oil production growth. What's lesser known is that the Permian is also the second largest region for natural gas growth. And if you're going to get the crude oil out of the ground in the Permian, you have to do something with the natural gas that comes with it. And that's where Kinder Morgan comes in. They are building out expansions of different pipelines like Permian Highway, Gulf Coast Express. Both of those will lend more takeaway capacity out of the Permian to places that can use it, like U.S. Gulf Coast. So they're pretty well positioned on that front. And I think that there's a lot of volume growth to come. Now, when it comes to the oil services names, like a Schlumberger or a Halliburton, the fundamentals there are not great. I would say, we're pretty neutral on the fundamentals, but many of these stocks are pretty beaten up. Schlumberger is trading about 30% below its historical forward average. Halliburton's pretty much the same. So these are really value calls on the argument that things probably are not going to get worse for the oil services space.
So value calls on those. But let's get back to Kinder Morgan because they're going to be reporting their quarterly numbers. Is there something, though, that you're looking for them to say, which really is that catalyst that gets them to that $35 target? You talked about volume growth really helping to propel this name. Are you expecting them to say something like that?
Well, I think what'll be interesting to hear is how they view the LNG export business today. And what the outlook for that is over the next, call it 12 to 18 months. That's been a big driver, a big safety valve for natural gas production because production growth has been pretty solid, mid-single digits for U.S. natural gas production. That's more production than we can really absorb domestically. So a strong U.S. LNG export business helps them considerably because it just adds more demand in places that they're already well positioned. So that I think is first and foremost. And then I think the second thing would be kind of cost inflation, questions of, how much exposure do they have to, rising costs for steel and whatnot that go into the pipelines that they need to build out.
And you also have Baker Hughes on here too as a buy, right? Mm-hmm.
Yeah, so Baker Hughes is similar to a Schlumberger or a Halliburton. They're obviously one of the big three in the oil services space. Baker is I would say relatively better off So we do have a buy rating on them. Their valuation is not nearly as steep a discount as what Schlumberger and Halliburton are doing. However, Baker has pretty nice exposure to AI data center demand because all those data centers require natural gas as fuel, and so you need gas turbines and whatnot to build those out and have them run successfully. And so Baker's industrial energy technology business feeds pretty nicely into that theme. So that's a nice feather in the cap for Baker. That's a bit stronger for them than for a Schlumberger or a Halliburton.
We're watching Ukraine and Russia and that story, and there's still obviously war and fighting happening, and maybe some more sanctions on Russia. Does that affect our oil prices? What do you watch there?
Yeah, it seemingly has not really fed into, a sustainable geopolitical premium, right? I mean, even when Iran and Israel were going at it, when the fighting sort of died down a little bit, crude prices came right back down with it. I think that where Ukraine and Russia really has influence is Western Europe's interest and appetite for natural gas supplies that come from someone other than Russia, right? Russia has proven itself to not be a reliable trading partner. Western Europe before the Ukraine invasion, got about a third of their natural gas inputs from Russia by pipeline. That's the cheapest gas there is. But when you can't count on a business partner being reliable, you start looking at other alternatives. U.S. is a huge opportunity. There are other players out there like Australia, Qatar, that also have natural gas for export businesses. But I think the U.S. is going to be one of the prime candidates for that. And as this war drags on, I think more and more you're going to see Western Europe try to move in the direction of anyone else aside from Russia.
And final quick question. I mean, oil right now at $65. They said how it was close to 70. Do you see 70 or 60 first?
Great question. I think that the Permian production is starting. I think there is some risk that the Permian production on the crude side is going to get a little bit constrained. Most of the E&Ps have gone through the best of the wells they have in their inventory. So I do think there's a risk that next year production may slow, the production growth may slow, and that may add a little bit of a boost to oil prices. So I would say 70 is probably a better chance than 60, but I'm not expecting 80 or 85 off to the races, anything like that. I don't think the demand case is there.
Oh, okay. Well, that was a good answer. Thank you so much, Stewart Glickman, Deputy Research Director, Energy Equity Analyst at CFRA. Always great to see you, Stewart. Thank you. Tom White, host of Fast Market, is with us. We're going to take a look here at Kinder Morgan. He definitely liked the idea that this is a volume growth player, even more than price to drive this. He had a buy rating and a $35 target ahead of the earnings, which you're going to be also mentioning. Tell me a little bit about your example trade, Tom.
Yeah, Nicole, going into those earnings, the option market pricing in about a plus or minus 80-cent move, right? So plus or minus 3% in the shares. This is a low price stock, doesn't move much. But one key thing is when you look at names like this, if, say you like it, is the dividend yield, 4.2% dividend yield. That's pretty good. And a lot of these companies, lower priced in the energy sector, have big dividends, right? So you can take advantage of that yield that you can create there. So I looked at a strategy. If you wanted to get maybe bullish, or maybe you think this thing continues to consolidate but doesn't go lower, this strategy takes advantage of it. Covered call strategy, where for every 100 shares of stock that you buy in KMI, you sell an upside call against it. I went up to the August 15th monthly option, so 30 days to expiration on this one, because there is not a lot of option premium in out-of-the-money calls. But selling the August 15th, the 28 strike call against it, you're going to pay roughly about a $27.5 debit. So you're buying the shares at a discount because you sold the upside call against it. You get to collect that dividend of 4.2% because you're long the shares. It gives you a little bit of room to the upside, But I think the key here is you create yield by owning the stock, getting paid out 4.2%, but then you can sell calls against your long stock. As you get closer to expiration over the next month, you can roll or adjust that short call, trying to create more credits. That's going to increase that potential profitability and also lower that break-even point. And the break-even point is the debit that you pay.
Okay. Thank you for that. KMI, we'll keep an eye on that. And then you have an example trade for Schlumberger, which also he thought that those three names, Schlumberger, Baker Hughes, and Halliburton, that those names had been beaten down. It was a valuation call. He had higher price points on buys on all of these. What do you think about an example trade for Schlumberger today? Yeah,
they report on Friday morning. Option market pricing in about a plus or minus just over 3% move in the shares, just over $1.10 either way in the stock. And if you look at the movement of the stock, it's down 8% so far this year, and it's trended lower over the last 2 years. It's off about 27% over the last 12 months. So it's at really extremely low levels. I believe they have CFRA has a price target of $50 a share on it. So I looked at something a little bit more aggressive in here, not an earnings play, but gives myself some duration on this. So I went out to the September monthly options here. So you got 65 days to expiration. We're just going to buy an in-the-money call. It's almost like a stock replacement type strategy. We're going to buy the September 32.5 strike call. It's got a delta of about 72, so it reacts more like the stock, right? And as I mentioned, a lot of these names don't have a lot of extrinsic option premium in there, right? So if I buy the 32.5 strike call, if I pay a debit of roughly about $3.60, that's going to be my risk on this trade, $360, as opposed to maybe buying the shares, which is more capital intensive. If I pay $360 debit, it takes my break even to $36.10 over the next 2 months. That's about 3% only above the current share price in there. IV percentile rank, only about 24%. So we're in the lower 1/4 of what we've seen implied volatility levels over the past year. So that lower implied volatility means I pay less for this bullish call purchase. But the idea here is you want it to go above 36.10. You're giving yourself 65 days, and you only need a 3% move. So giving yourself duration, maybe that catalyst on earnings. But even if it doesn't play out on earnings this Friday, you still have time in this position for it to go above that break even at 36.10. And anything above there is profitability.
Okay. Tom White, great to see you. Thank you so much. A good look at both of those names. Appreciate it.